Good afternoon, everyone, and thank you for joining us today for our presentation on the 2022 Investment Outlook presented by Kurt Spieler and our panel of wonderful participants from the Wealth Management Leadership Team. My name is Chriselle McNeil, and I'm joining here today to help us move through the presentation and gather questions from you as our panel provides their thoughts on the economy and market. We hope you've all had an opportunity to read through this year's Outlook, and if so, you'll notice Kurt will be covering it in a slightly different format. First, we'll go over the positives in the economy, then the risks we see in the economic outlook, followed by our portfolio strategy. Throughout the presentation today, we'll be addressing questions from the panel here in the room, as well as gathering questions from you in the audience using the Q&A function located at the bottom of your screen. At this time, I'd like to invite the panel in the room to take a moment and introduce themselves. I'll start with Stacy.
Good afternoon. My name is Stacy Alman. I manage our client portfolio management team, individuals throughout the First National footprint that serve our ultra high net worth trust and institutional clients. And I've been with the bank for just over 20 years.
Good, Stacy. I'm Steve Lindsay. I lead our specialty services group, which is to include financial planning, personal trust, and specialty lending. And I'm a 26-year veteran of FNBO.
My name is Ryan Decker, and I'm a regional manager in our advisor-led wealth management segment. And I'm going on 9 years at the bank.
Well, thank you all for joining us here today. We look forward to your insights. And with that, I'll turn it over to Kurt to begin.
Thank you, Chriselle, and appreciate all of you attending and participating. As we mentioned in our opening comments, we want to make this as more of a conversation, hence the panelists, but also wanted to encourage you using the Q&A function to ask questions. As it was alluded to, I'm the Chief Investment Officer, been with FNBO 16 years, ultimately responsible for investment strategy, the implementation of it throughout all of our various customer portfolios. So ultimately, I'm also responsible for this meeting. And so once again, appreciate your attendance. So to get started, as Chriselle mentioned, we're going to talk about the positives here, and there are quite a few within the economy. What our first chart here shows is the 2021 economic growth, GDP or gross domestic product growth for each of the last 4 quarters. On average, economic growth has been around 5% for the year, which is well above the trend line growth of 2% that we've seen for much of the last 10 years. You do see one outlier there, the third quarter, in which growth slowed temporarily due to some supply chain disruption, some other issues that was facing the economy. But overall, the economy enters this year with a lot of momentum. When you evaluate the U.S. economy, we start with the consumer and how is the consumer positioned. If you look at personal consumption expenditures over the last 5 years, what you can see is pretty consistent growth until COVID hit for both goods and services. And quickly to define goods, that would include durable goods, so autos, appliances, furniture. It would include non-durable goods, food, energy, clothing. Services would include healthcare, education, as well as travel and leisure from that standpoint. And so what you really experienced last year was an acceleration in the goods services, which did put pressure on companies and ultimately inflation, which we'll talk about here in a few minutes. But overall, the environment's been positive for consumers. When we evaluate whether that will continue, we start with where do we stand from a financial situation? What is the debt levels of individuals? What this chart shows is the consumer debt and the household debt payments as a percentage of personal income over the last 15 years. As compared to the recession in the 2008-2009 timeframe, you saw significantly higher levels of debt and leverage of individuals at the 13% level, but a pretty constant decline since then over the last 13 or 14 years, including hitting a all-time low here of 9.2% earlier in 2021. So overall, we would say consumers have benefited from the low interest environment. They perhaps have paid down debt, with some of their cash flow and income that they've generated, and overall are in a pretty good position.
Kurt, I got a question on this. So last month, it was reported that U.S. investors are sitting on record amount of cash and cash equivalents. How do you think this will play into the market going this year?
Yeah, overall, we would say it's a positive that consumers and individuals are sitting on cash. This is the first recession that we've went through, and that would have been the 2020 recession, in which the savings rate went up. And so people, when they were spending less during the government shutdown of the economy, saved more money. So especially upper and middle income individuals, you did see some benefits from not spending and savings. They maybe paid down debt was part of their approach. And then some of the extra stimulation activities from the federal government, the extra checks, the extension of unemployment insurance also helped throughout the income spectrum. So in general, individuals have low debt and they have excess cash, and we think that leads to at least the potential to continue spending as we get into this year. The other aspect that we look at is what's going on from an income level perspective. And the most important part of income is from the labor market. And so what this chart shows is the number of US total unemployed workers over the last 5 years. And you can see the spike, obviously with the layoffs in 2020, but the pretty consistent growth in employment since then that's resulted in total US unemployed workers of 6.3 million at this point. And so if you look at it on an unemployment rate, another commonly cited labor statistic, the unemployment rate of 3.9% last month, which is fairly close to where we were before COVID. So the unemployment hit a low of 3.5% here early in 2020. So overall, this situation, looks good from an employment, from an income standpoint. We see that's being factored into the housing market. So if you look at this chart shows the residential housing demand and the home ownership rate. And so the demand people spend, as we mentioned previously, on goods and to a lesser extent services. They spend on their home, they perhaps upgraded their home, increased footage, built new homes from that standpoint. But have we created a bubble similar to where we were in the 2008 timeframe? In our opinion, no, from the standpoint that home ownership is still at 65%, well below the peak that we experienced here in the 2005, 2006 range when home ownership reached 69%. The other chart that we're not showing today is the supply of homes has consistently been below average from that standpoint, or below the demand levels. And so you still see low inventories in various markets. And so from our perspective, what's driven the price increases of approximately 19% throughout the US has been more the fundamentals of the economy, with demand once again outpacing supply.
So as we look at this, Kurt, I think in terms of mortgage rates are already off their all-time lows by about 0.5%. And by all accounts, they're going to continue to go up. How do you see those interest rate increases specifically affecting housing prices?
Yeah, similar to autos, housing and residential market is sensitive to mortgage rates and affordability ultimately, and affordability has become more stretched. The way we would look at it is, absent a spike, which I would define as from here, 1% or more increase in mortgages. I think that would create an affordability issue in the US. But without that type of spike in interest rates, we think the housing fundamentals will remain strong enough. So if we get another 0.5% this year, similar to as what you alluded to, Steve, last year, I think the market can withstand, that modest levels of increases. So it's a risk out there that you'd see a spike, but at this point, the fundamentals are strong. If you look at the recent data, it's continuing even with higher interest rates, and we see the demand as kind of seen on this chart as continuing as we go forward. So individuals, in our opinion, are in pretty good shape, from income, from savings, from debt levels. How about businesses? Companies overall are extremely profitable at this point. So this is the S&P 1500, which is a broad US market index encompasses the largest companies that you would be familiar with in the 500, but also includes some small and mid-cap companies. And this is their net profit margins. So this would be after tax, it would encompass the low interest rates. And so you'd see some of the benefits that we've seen in the current environment. What it also reflects that improvement into profitability to now close to 12.5% is the benefits from the revenue growth environment that we've been in over the last couple of years. The operating leverage companies have, productivity improvements that you've seen, the low interest rates, and then the lowering of tax rates. You can see that back in the 2018, 2019 timeframe. Companies, are extremely profitable. Their balance sheets are in a good place as well in terms of financial strength. Why this is important from the economy is invariably companies spend some of that improvement. So if you look at investment spending surveys or what is the planned capital expenditures for companies, and this is a survey of 5 different industries, pretty broad-based from consumer to industrial to transportation. You can see in November 2020, in total, you're expecting for this year a 2% growth in investment spending as compared to the prior year. Today, it's 40%. So companies plan to spend some of that additional profitability. If you look at where it's being spent, IT spending, so technology, 60% of companies plan to increase their level of tech spending this year. It's in a variety of different ways. It's work from home still, automation, digitalization of companies. So it's pretty widespread in terms of further improving the efficiencies and hopefully the profitability of companies with that plan. So in our opinion, pretty good environment for individuals and businesses, but it's not all rosy from an economic standpoint. As Chriselle mentioned, talk a little bit about switching to what some of the risk that we're seeing. And the number one risk that we would point to without question is inflation. And what this chart shows, the same GDP growth last year, the 5% that I mentioned previously, but also you see the inflation as defined by the Consumer Price Index or CPI. And what you've seen is after running consistently below 10% or 2% for much of the last 10 years, what we've experienced is closer to 5 to 6, and even the latest number is 7% inflation. If you talk to some of the companies that we work with, construction being one of them, what you see is, it's not 5 or 6 or 7% inflation, it's 10, 20 and beyond. And so there's certain industries that are seeing some supply disruption or just escalation of prices in a significant way.
Kurt, I got a question on this. So last fall, the Fed discontinued their transitory word when they talked about inflation. But now we are seeing persistent price increases across the supply chain and wages. How do you think this is going to look going into 2022?
Yeah, let me first answer that, Ryan, with initially, I think the Fed thought it was temporary, which is transitory language, isolated to a few industry, automobiles, semiconductor chips, some commodities. But it's clear as this year progressed that you've seen a broadening. So it's more and more industries being impacted, not just the ones that did not have enough goods to sell from a supply standpoint, and to it's really broadening. There is an expectation still in the marketplace that inflation will come down, that it's really at the highest levels that we're going to see in this cycle today. I would say we believe that inflation is going to decline, but it's still going to be stubbornly high. And so we expect inflation to still be an issue throughout the entire year, not just in the beginning of the year. So well above the 2% Federal Reserve inflation target. You alluded to that in your question a little bit, in that part of this reason for this expectation is because of the impact of wages. We've been talking about for much of the last decade that you don't see inflation until you get wage inflation. And what we're experiencing here in the US is we do have wage inflation today. And so this chart shows, once again, the core CPI, so that excludes food and energy, and the employment cost index, which is a method that's widely used for wage growth. And what you've seen is, 2 to 3% for much of the last 4 years, and then the recent spike that you've seen. So we have experienced inflation heading towards 5% even on the core level, so excluding what we've seen in food and energy once again. But we've also seen wages pick up 4 or 5% type level, depending on what you're looking at. One thing for us to watch and analyze is just this impact that for a period of time, inflation was above what we were seeing in wage hikes. And so we look at it on a real disposable income basis, and that's just defined as income after inflation from that perspective. And for a little while here, we experienced inflation running higher than wages. We do think that's starting to change here, as shown in the chart, and we expect that to continue. So we believe inflation will continue to be at fairly high levels, but wages are going to stay sticky on the upside, which will lead to kind of inflation being stubbornly high. A big piece of that thesis is the labor market. We talked about how unemployed workers have come down to the 6 million plus range, but we've also seen job openings pick up quite a bit. And in talking to a lot of the businesses that we bank with here at FNBO, a shortage of workers is something that they consistently talk about. I think the other survey that's being seen is 53% of companies would like to hire more, but they can't find workers. We believe this is a multi-layer problem. It is experience, so finding qualified workers with experience at those job points. And there's a variety of other reasons that's leading to this gap, which is almost 4 million jobs more in terms of openings versus the unemployed workers.
Kurt, what impact does the labor participation rate have? So there's been a lot made of, people that are, leaving the workforce, less available workers out there, people looking for jobs. What impact does that have on, this issue?
Yeah, if you look at it, let me define it. So participation rate is people over the age of 16 and not at retirement age that are looking for a position, so in the workforce. And what Stacy's referring to is one of the things that have come out of the COVID environment is participation rate was running about 64% in the economy for people of that right age demographic, and it's declined to the 61 to 62% range, and it's only starting to creep back. It's interesting, I guess, to answer your question is it does vary based on the age. So one of the reasons for this gap in 4 million is early retirements. We're running a couple million ahead of schedule in terms of people that retired. So it's the age 55 and above that have not come back into the workplace that perhaps they laid off, so they decide to retire early and take early retirement. And so far, you haven't seen a lot of that come back. The other age group that's been not participating in the job recovery has been less than 25. So people are starting work later, perhaps going to college and not experiencing that. If you look at how this economic cycle plays out, labor participation is an important piece of that theory. So if that creeps up, that allows for a more robust and an expansion that continue further on, from that perspective. So two risks there. I think the inflation, the tightness in the labor market. The other thing from a financial market perspective is, well, how is the Fed responding to the change in the macro environment that the U.S. economy is experiencing? What this chart shows is the Fed dot plot, so Federal Reserve, and what they expect to do in interest rates. It was pretty interesting until October of last year. You had interest rates at 0%. The Federal Reserve was continuing to buy 120 billion of securities a month in both treasuries as well as mortgage-backed securities. And they've changed their tone and language, as Ryan alluded to, in terms of taking out the transitory inflation language, but also reducing the amount of quantitative easing or balance sheet purchases. And they have also signaled to the market in December that they're going to start to increase interest rates. And so you see in the green is the Fed Reserve expectations of 3 interest rate hikes, we think starting in the spring of this year. And then you see 3 more in December 2023, and then 2 more there in 2024. So a pretty significant change, which for us, we think will impact in terms of the financial markets and a change from the most accommodative policy in U.S. history, which is what we've been running since March 2020 through October, to a change in their tone and a tightening, or at least they're forecasting that for the market.
So Kurt, as I look at this chart, I think in terms of, at zero and wondering why in your mind did the Federal Reserve wait so long to signal rate increases? And then depending on that answer, do you have confidence in the Federal Reserve's ability to manage this rate increase up quickly enough, but yet not too quick?
Yeah, I would say to answer your first question, not to duck the answer, but I have no idea why the Fed waited so long. I mean, we believe it was a mistake for the Federal Reserve. The quantitative easing, the 120 billion of securities that I mentioned, was put in place to normalize credit conditions. Well, credit conditions were normalized by the beginning of 2021, a year ago, from that perspective. So why continuing to stimulate demand by buying securities, mortgage-backed securities? We already talked about home prices not, supply not keeping up with demand, prices being up 19%. At the same time, they're trying to stimulate more demand in housing. So from our perspective, it was a mistake. It doesn't make sense. So the second part of your question, do we have confidence? I'd say skepticism. They are now behind the 8 ball in our terminology in terms of needing to catch up, needing to be more aggressive. So the longer you wait, longer you change course, then the more you have to do is the risk. So that can they come through and in essence navigate a soft landing? I'd say there's some skepticism. They didn't get it right last year. Are they going to get it right this year? I think remains a question.
So Kurt, looking at this chart though, why is there such a big disconnect between what the Fed is forecasting and telegraphing versus what the market is assuming? The market seems to be assuming a very less aggressive rate hike cycle.
Yeah, so market is in the blue here, which I didn't talk about. 3 rate hikes, and I guess it's 2.5 rate hikes, so there's no consensus, and then really nothing, or maybe a half a rate hike there in 2024. I would say we're not the only ones skeptical. The Federal Reserve has lost credibility in the marketplace, and so what this chart is saying is, the Fed is talking about how, they're pivoting, they're focusing on inflation, employment's close to full, from that standpoint. But what happens when there's a hiccup? The stock market's been weak so far this year. If you see a correction in the stock market, will the Fed stay the course? And potentially, they are, as always, data dependent. So if the economy starts to slow or you see better signals on inflation, does the Fed stop earlier than what they're forecasting? And the market's saying, in essence, you're a bit of all talk and we'll see in terms of do they actually come through. I think the reason when we talk about that this is significant is, last year, a lot of positive equity market returns, strong economy, great earnings. Earnings growth was 35% last year. You had the most accommodative policy. That environment's changing as an investor. One of the areas that we also see is bonds are expensive in this environment. So this chart shows the 10-year Treasury yields. This is at the end of last year. And then on a real interest rate basis, which, similar to my prior definition, just takes out inflation. So interest rates at 1.4%, you see a pretty steady decline over the last 15 years, but even a bigger decline on a real interest rate basis to -3%. We haven't seen -3% in real interest rates since the mid-1970s when inflation was double digit from that standpoint. So from our perspective, especially after inflation, it's hard to envision, that bonds are going to stay where they are today. And in fact, the 10-year Treasury has moved up to the 1.8% level since this was written. And we've experienced interest rates already start to ebb a little bit higher.
So with clients, if they're looking to generate income off their portfolio, whether it be, as they're getting closer to retirement or looking at using that to supplement income needs in retirement, what are the options? I mean, rates are rising, but it will take some time to really materially increase income from portfolios. So what are some potential options for income?
Yeah, that's a difficult answer. We've been in a low interest rate environment. There are some opportunities within credit markets. Our fixed income team would say some corporate bonds, structured products, or asset-backed or mortgage-backed securities. We've added exposure to floating rate securities that should do well if interest rates start to rise. But the reality is we've, for the last few years, including in today's environment, started to diversify. So you're looking at whether it's conservative equities within, large value companies that pay a high dividend, real estate investment trusts or REITs are also possibilities. So it's looking at how do you generate income within a diversified portfolio, and that's going to continue to be a challenge. The other thing that I like to say is for customers that have bonds is they still provide protection in a recessionary environment. So there is an environment where interest rates go down, if and when we go into a recession. So, there are some benefits from that. But if you look at it, this policy, this low interest rates really favors borrowers to the detriment of savers and investors. And so this means taking more risk to generate the same level of income. So don't be afraid as an investor for interest rates to rise. Yes, in the short term, it may mean your bond prices go down, but in the long term, you'll earn more from your bonds, and therefore you can have a more conservative asset allocation, from that standpoint. So a lot of moving parts, but we would say, diversify the portfolios, look to other areas, but, also at this point of view, be prepared for, at least in the short term, similar to last year, some negative or flat returns within the fixed income market.
Kurt, one question that came in, just kind of again, can you define when we're talking about real interest rates, what is that? What are the measures used to determine that negative real interest rate?
Yeah, so this is effectively the 10-year Treasury yield minus core CPI from that standpoint. And that just, as I mentioned earlier, excludes food and energy from that prices. So the core CPI number, as we showed on a prior chart, is running about 4.5% here, and that's how you get to the negative 3%. So it's just a calculation that you can run. Core CPI usually comes out on a quarterly basis from that standpoint, and we have just received the interest number. So it's the way that we gauge to determine how the real economy is doing from an economic growth, so not factoring in prices, but also what you're earning. So, if you buy a 10-year Treasury, you're going to get 1.4%, but if inflation stays where it is, you're actually getting a negative return. You'll have less pricing power with that money at the end of that 10-year time frame. Turning to equities, equities are also expensive. I think that's been widely shown in the media. What this chart shows is the NTM, price to earnings ratio. NTM stands for next 12 months. So the PE ratio is about 20 times at the end of November. If you look at it, it is expensive relative to the 15-year average of 15.5 times, from that standpoint. So the market is pricing in. Usually we look at valuations as a sentiment indicator. So it implies that individuals are fairly optimistic about the company, the expected company earnings, and that interest rates also factor into that valuation, that they're expected to remain at least reasonably low. The interesting part is a great market last year for the U.S. stock market in particular, large caps here as represented by the S&P 1500. But actually the valuations over the last year got a little bit cheaper. That earnings growth, as I mentioned, actually exceeded the stock market return. For the next 12 months, the market's expecting about 10% type earnings growth. And so that's kind of a key. Can you grow in to those more expensive valuations? The other part, we find a market cap weighted index a little bit misleading because there are opportunities within the stock market. So what this shows is the most expensive areas in the stock market are in red, which would be U.S. large cap as represented by the S&P 1500. But large cap growth, you see 35% and 65% premiums. And so some of those are the mega cap stocks, the Apples, the Microsofts, Google, Facebook, Tesla. They're all more in growth industries, and they become expensive. And that area of the marketplace is driving up the overall stock market valuations. One of the best areas in value that we see is within U.S. small cap, and to a slightly lesser extent, mid cap. So there are opportunities, what we call small and mid is SMID. From that perspective, you see discounts. And so some of that frothy or higher valuation, we are seeing opportunities within the SMID cap area. There's also a pretty big difference between value and growth. So some of your value indices are trading at discounts or smaller premiums than your growth index. And so there is some opportunities on a sector basis and on a style basis in terms of where we're finding cheaper valuations. because of that strong performance that I mentioned in the US market, what you've seen from those mega caps is a concentration in the overall S&P 500. And so the top 5 stocks represent about 21.5% of the market. And so there is risk in terms of how does the market go, at least in large cap land. Well, it really depends on how those mega caps are going.
So Kurt, given what you said about the concentration in the S&P 500, how are we managing these risks from a portfolio management? And Stacy, this is a good one for you too, being head of portfolio.
Well, I can go first,
Sure.
and then you can add in, Stacy. As part of our investment approach, we make tactical decisions. So we are adding exposure to small and mid-cap managers is one area. So we, in essence, tilt portfolios towards what we like the most in the marketplace, which also implies then that we're selling from large cap growth or reducing exposure from a risk perspective in terms of those most expensive sectors. So that's kind of the asset allocation. That's the manager change. You see that within individual stock portfolios. You'll see the investment teams focus on those areas of the marketplace. So you'll see that whether you're invested with us in mutual funds or within individual stock portfolios.
Yeah, to highlight some of that. So, when we talk about that concentration in Apple, Microsoft, Google, those are stocks that we own in our strategies. But again, when we look at kind of the disciplined approach we have to portfolio management, whether that's in our individual security strategies or in our mutual fund strategies, is, our managers have been taking profits over time. Again, still holdings that we have and like, but again, when stocks are appreciating 30, 50, 60% a year, that can't be compounded. So in individual security strategies, we're taking some profits on those big names that have done well. In mutual portfolios, we're looking at making some changes. We talked about the concentration in the S&P 500. So traditional indexing is about buying a market cap weighted list portfolio of stocks. So the bigger the stock, the Apples, the Microsofts are the top holders at 5, 6, 7%. And the smaller the company, the less the holding. Well, we're making some adjustments to our portfolios early this year to move some exposure from the traditional market cap weighted S&P 500 portfolio to what's called an equally weighted position portfolio. So then instead of Apple being 7% and the smallest company in the S&P 500 being less than 1%, each stock in an equally weighted S&P 500 portfolio has the same weighting. So by doing that, in effect, we're reducing our exposure to some of those mega cap names and getting broader diversification. So by nature, we're selling the largest, or not necessarily selling, but we're underweighting the largest and putting more weight into some of those mid and small cap names. So again, depending on the type of portfolios, it's being done differently, whether it's individual securities or if it's in mutual funds. But again, something that we're trying to be consistent across all the strategies that we run, because that's one of the things that we want to make sure that clients are getting, regardless of the type or size of the portfolio, we're being consistent across all of our clients' accounts.
Yeah, I think that's a good summary. And the way we're looking at it is being in large cap growth was the place to be the last 10 years. We don't think it's going to be the place to be in the next 10 years from that perspective. The other option, if bonds and stocks are expensive, that we've made changes to the portfolio over the last 8 to 9 years, is within alternative investments. So previous to 2013, we had zero exposure. And how we're using this is primarily within mutual funds or what's called liquid alternatives and increasing exposure. Our primary holding today is within a hedged equity fund that provides you with some participation if the stock market continues to go up, about 50% participation rate. But it also performs very well if you get a 5 to 20% correction in the overall market. We also added last year a commodities fund, so taking a look at inflation and the sustainability as part of our economic thesis and wanting exposure through with commodities. The last iteration that we're putting in place this month is within a convertible arbitrage, so a hedged fixed income. You could say funds that will do better if interest rates start to rise. So we're looking at it as if bonds are expensive, stocks, some of the market's expensive, some of it, there's opportunities there. But we don't want to just continue to buy more and more stocks to produce returns. So we're using alternatives to do so.
So Kurt, one of the things that that I've been hearing more and more from clients is around cryptocurrency. That's an alternative, it has a different return stream, has done very well, but can you talk a little bit about kind of First National Bank's thoughts on cryptocurrencies and how they fit in a portfolio?
Yeah, so obviously getting that question, especially early last year, Bitcoin performed particularly well. We would say it's not really hit the institutional advisor, which is what we consider ourselves. So we don't have the ability to buy Bitcoin or other cryptos or tokens from that perspective. So there's some limitations we can do. There's some advisors out there saying, well, have clients buy directly 1% to 2% of their net worth. We would say overall, it's a very speculative environment. It's not regulated at this point. And I think there's questions in terms of Bitcoin and other currencies that are focused solely on being a store of value. So we don't expect Bitcoin to replace the US dollar, euro, yen, renminbi. So some skepticism of that. Bitcoin did perform poorly the last time the Federal Reserve was increasing interest rates. They call it the Bitcoin winter, which was around an 80% correction. Having said that, we find digital assets, this is an emerging asset class, and there are a lot of research, a lot of capital being invested in terms of blockchain technology and the uses of cryptos or utility tokens as it's talked about. But since I've kind of covered my extent of expertise, I know Ryan's done a lot of research in this area, perhaps a little different generation, as well, that might help them with digitalization. So if you want to kind of talk about your thoughts there in terms of whatever the regulatory environment, what you're thinking of, how you would look at both cryptocurrencies as well as other tokens of value.
Yeah. So when we talk about crypto, there's a broad range of applications. Kurt, you kind of mentioned on a couple of them. There's some meme coins like Shibu or Dogecoin that's been in the news quite a bit. There's more utility coins like Solana or Ethereum. And then you have more cryptocurrencies like the Bitcoin that we're familiar with. But at the end of the day, we're also seeing tokenization. So you've seen this in the art world with NFTs, which is really just a way for digital ownership. And like I said, it started on the fringes in the art world, but it will move to other industries in terms of digital ownership. But at the end of the day, the blockchain is really the technology behind this crypto. And it is a new fundamental operating system that will impact many industries, from how we trade securities to how we buy our food to how we close on a mortgage. But at the end of the day, it's still a very nascent technology. Like you said, it's highly speculative. And you also mentioned about regulation. And last fall, the newly appointed SEC chairman, Gary Gensler, kind of put a target on cryptocurrency regulation. He got to the point where at $2 trillion, it's just too big to ignore. So we will likely see some sort of regulation this year, or maybe more clarity around what they're thinking. But at the end of the day, from an investment perspective, it is highly speculative, and we feel that you should only invest in what you're comfortable in losing.
Let's switch focus. So how do we pull the economic outlook, our market views in terms of what's expensive? What is our expectations? What's the crystal ball question for forward-looking returns? What this shows for major asset classes, U.S. large caps, mid cap, real estate, international alternatives, what was the last 10 years? And a great environment. So this low interest rate, low inflation environment led to some really strong returns. U.S. large caps were up 16%. The blue shows the next 10 years, and because of those expensive market valuations, we're talking about more like 7% type returns for some of your more risk-oriented assets. So when we're looking at our tactical decisions that we refer to, we still favor equities over fixed income, but we're also cautioning clients that returns are likely to be a little bit lower, going forward in the future, and that's just a starting point. Valuations are a poor market timing indicator. So we can stay expensive. We have been expensive for the last couple of years, and that didn't stop the market, as I mentioned, from going up last year. But over time, we expect you to gravitate back towards those average valuations, and which leads to a little bit more of a conservative return assumptions. So that's part, of our financial planning process.
Kurt, I got another question on this chart. So if you look at the last 10 years, you've already talked about large cap and SMID and bonds and cash. But look at international. I mean, the last 10 years and the next 10 years seem to be pretty consistent with returns.
Yeah, so internationals has lagged. We've maintained a fairly low allocation by industry standards in the 10 to 20% range, but we've been consistently rebalancing or buying back international. The big determinant of international returns is what's happening with the US dollar. So US dollar weakness is better for the economy as you bring your money back from those international stocks that are performing while converting back into the US currency. What we've seen over the last 10 years and why returns are disappointed is persistent strength in the US dollar. And so that's negatively impacted returns. The reverse is obviously also true. If you look at the outlook for the next 10 years, I would say most economists expect the US dollar to be weak. You have the twin deficits, the Federal Reserve or the trade deficit that we're running, as well as the federal government and the budget deficit, the $3 trillion that we're running in terms of a deficit in 2021. So that should weigh longer term over the US dollar. The other aspect of that is international markets are cheap. So relative to that US large cap, international stocks are as cheap as they've been, in the last 20 to 30 years. And so that valuation squeeze that we may see within the US market, the international market, there's not as much optimism, as much confidence about the earnings and economic environment. And so we don't see that weighting and valuation coming down.
So when we look at this and we look at low interest rates, the ability to rise, and maybe Steve, this is more of a question for you, kind of with your background in lending and private banking. But, if we've got, Ryan talked about, record amounts of cash on the sidelines, if you've got cash, let's say you have some outstanding debt, what's that balance? Should I be paying down debt? Should I be holding on to my cash? What do you think from a kind of a borrowing and investing standpoint?
Yeah, obviously that question, there's really two types of borrowers. Ones that borrow because they don't have the liquidity, and those that are borrowing and using leverage as part of a greater strategy. You're only talking about the latter in this instance. And so in my mind, it comes around really down to three things. The first is, what is your comfort level with debt? And that's personal. That's based, it varies from client to client. What is your comfort level, and how does it fit within your financial plan to continue using leverage or to eliminate it with cash? The second piece of this is tax deductibility. So if it is mortgage debt, there may be a benefit not beyond just having a long-term low interest rate, but that you also have tax deductibility on top of that. So that's the second consideration. And then the third consideration is, if you're using leverage when you have cash, is you have to have a replacement. So what is that replacement investment? And in my mind, I'd actually throw that back to you, Kurt, or to Stacy, is kind of back to this slide. I'm looking at this thinking, boy, it's really tempting for me to keep that low interest 10 or 15 or 30-year mortgage rate, but I've got to come up with somewhere in cash, and it's got to beat that. And those blue bars all of a sudden aren't looking as good. So what do you say to somebody who's either staring at cash now, or who's considering a liquidity event or liquidating some form of asset into cash? How are you walking them through this, which is a different journey these next 10 years?
Yeah, I would say a couple of points. First of all, we believe you should stay invested or get invested and stay invested. So cash, is one of the worst areas to hold in an inflationary environment. And so we're more of stay the course, that ultimately the time that you get in, it's more about time in the market than trying to time a low point at a better valuation standpoint. So that's one part of the answer. The other part that we would say is average into the market. It's something that we believe strongly in. So don't go from 0% invested or invested holding cash to 100% invested in day one. So I think that's an important part of that equation. Pick the time frame that you're more comfortable. This allows Stacy and the portfolio management team to opportunistically look and say, hey, the market's been off for the last few weeks. Now's the time this month to perhaps buy into the stock market or buy into fixed income if you see interest rates spike up. So being careful how you invest, but then staying invested. And the key to that, in terms of how to stay invested, is to be in the right asset allocation. That's the primary determinant of return. And by that I mean, how much do you hold in stocks, bonds, alternatives, cash, the rainy day fund that you may have. So come up with the right asset allocation. We have financial planning team in both Steve's area as well as Ryan's area that can help with that process. But I think that's a key, is making sure that, if you are been accumulating this amount of net worth and cash all your life is, well, how to invest it prudently, but then stay invested and make your money work for you from that standpoint. I think that's a good close for maybe our opening remarks. I know we wanted to leave up to 15 minutes for additional participant questions. So as a reminder, the Q&A function, I know Stacy's already asked 1 or 2 questions from that, but I would encourage you to ask questions. I do know we got a couple of advanced questions as well.
We do. Thank you all for the great discussion in the room today. We do have some questions that came in previously, so we'll go ahead and dive in. Kurt, what are your thoughts on preparing ourselves for 2 to 3 years of lower returns?
We kind of talked about that a little bit in this page. So the way the market typically works is it's not necessarily a steady 2 to 3 years of 3 to 5% returns. Most likely, you'll get a down year during that time frame and an average year and maybe even a higher than expected year. And that's the part about market timing that doesn't really work in staying invested is you don't know when it's going to be the 25% year like last year or the negative 10% year that'll be forthcoming. So it's not to prepare yourself for consistently low returns. I think there'll be good years and bad years from that environment, but that is part of our education process that we're talking about is the last few years have been great. The next few years may still be great, but also just preparing that over the long term, you're going to have more of a down year. And just to remind people actually that over a long time frame, the stock market's only up 3 out of 4 years from that standpoint. So that means every 4th year that you potentially have a down market year. And that's certainly possible this year as well as over the next few years.
One of the questions that we had came in about interest rates when you were talking about the slide with the 10-year treasury negative rates. And Hark, you mentioned the 70s was the last time you've seen it. Well, that brings up a point of increasing inflation, moderating economic growth, potential for stagflation. What are any thoughts or discussion points that the investment teams had around that risk?
So stagflation, the risk is essentially that you don't get any economic growth or very little growth, but you still have ultra high inflation from that standpoint. Right now, we're not in a stagflation environment. So economic growth, as we mentioned, is closer to 5%. Inflation is a little bit above that in today's environment. I would say that that's certainly a risk, but a pretty low likelihood of that occurring because in general, what's creating the inflation started with at least more demand than supply. If you get lower levels of economic growth, the reality is you're getting less demand. So some of that demand supply imbalance, and it will vary by industry and at the company level as well, will start to dissipate. So as economic growth plummets, demand plummets, probably less pricing pressure would occur. So I think what's maybe more reality is if the Federal Reserve, as we discussed, doesn't navigate the soft landing, is both growth and inflation come down, but maybe inflation comes down a little bit slower. And that can have an impact in terms of interest rates, how much the Federal Reserve has to do. And I would say that's a risk, but not so much stagflation because once growth takes a hit, inflation we think will fall.
Looking and going back to the stock market, and we talked a little bit about how growth's done well and the premium there, maybe going down to a sector level, technology being a big driver of growth stocks and good performance. We've seen recently some better performance out of financials and energy and maybe a little bit of rotation. What's kind of the thoughts at maybe a sector level rather than a market cap level looking into 2022?
Yeah, I would say whether it's the value equity team managed by Mark Weininger or the growth equity team that's involved, we're not sector rotators. So you're not seeing us go from the 28% is what's in technology today. You're not going to see us manage 15% in technology. So we're not moving around trying to guess what the economic environment is going to be. But we do tilt portfolios. And I'd say if you look at our individual stock strategies, it is the more value-oriented cyclical areas of the economy that we're seeing, some increased exposure to by our equity managers. In addition to financials and energy, I would say industrials are an area. And then at the margin, we are trimming back those growth areas of the marketplace, which have the tendency to be information technology and parts of healthcare. So where we do or add more of our value on the individual stock strategy is owning the right companies in those industries, and that does include applying a valuation discipline to those companies. So you do see it maybe more at the company level in terms of that application and how we invest in stock portfolios. So I think that's kind of a key, is not necessarily trying to rotate in or out of the sectors, but moving into companies that play into that theme that valuation is going to be important. The other aspect I'd say is the growth versus values is really interest rate sensitive. So if interest rates go up, value stocks have the tendency to do better. That's just how the discounting mechanism works for future cash flows of the company. Growth stocks, are looking at the value of the companies more, their earnings in 10, 20, 30 years. And if you're discounting that back at higher interest rates, that's going to negatively impact growth. So there's an environment for us that says we think interest rates are going to ebb higher. They have been, over the last year. We think that's going to continue this year, but there's certainly a scenario where it goes the other way. And that's why we believe maintain a diversified portfolio and then just don't make sector bets or individual sector, stock selection just solely on one possible outcome in terms of interest rates going up.
Another question here in regards to the infrastructure bill that was passed in the end of last year. What impact or potential opportunities does that infrastructure bill, have for potential investment ideas?
Yeah, we would say fairly limited. That bill will provide some benefits from economic stimulus, but it's over the long term. So it's not a 2022 event necessarily, but you'll still see some companies in certain industries benefit. So that would go into, for individual stock strategies, that'll go into the thesis for that particular company, if they are receiving additional cash flow, government contracts, et cetera, as part of that. So it's not, to us, it's not a market moving event from either a GDP growth as well as for most companies. But at the margin, certainly there's a tailwind that companies may experience in terms of increased revenues and profitability.
Kurt, can I piggyback off of that? Because a lot of the clients that I talk to, they are very concerned with what's going on in Washington. Can you talk a little bit about what's going on in DC and how that's going to affect the economic and market outlook?
Yeah, so as a reminder, what we've talked about for years is policy matters, not politics. So we're always evaluating where we are from a policy standpoint, what becomes law. The biggest example of that is a lot of talk about higher tax rates, capital gains in particular. We have clients asking us, should I sell to take advantage of lower capital gains? We're like, well, it's not law from that standpoint. In our view, it's unlikely to have a change in capital gains this year. The probability, the longer we go on and get closer to midterm elections, less likely that you're going to see a tax increase. So that's a piece of it is, and to us, policy can matter. Tax policy certainly is one area that we'd look at. It then takes it down to what does this mean for the economy? What does it mean for companies, their profitability, their ability to grow their businesses? Because ultimately the stock and the bond market is priced on the fundamentals that's occurring in that area, from that particular standpoint. So it's much more important to look at what's the economic impact from any sort of policy changes compared to do you agree with it or disagree with it? So we'd say don't make investment decisions on politics. The other area that we haven't discussed is we've talked about how economically we're positive on the consumer and businesses. They have a lot of cash, profitability to spend. But based on current law, the amount of deficit spending that the federal government is putting in place is going to come down. So I mentioned earlier, $3 trillion last year. The estimates from the Congressional Budget Office is $1.1 trillion. Some of that is stimulus activity, less unemployment, insurance benefits, extra checks that we talked about, the ending of the child care tax credit at the end of the year. And so you're starting to see the government pull away from unsustainable levels of spending. And I think that's been a piece of it.
Question here that is maybe a little bit less about the outlook, but it's in regard to kind of maybe the First National Bank Wealth Management. And we've been talking to some clients about the expansion of our relationship with Raymond James. We've got some clients that have been transitioning platforms from our legacy trust platform to the Raymond James platform. One question is like, how does that impact the investment team and how strategies and portfolios are managed?
Yeah, that's a great question. From our perspective on the investment team and the leader of the team is we're looking at providing the existing strategies in different platforms. It could be using Raymond James as a custody, could still be the trust desk. In Steve's area, it could be the institutional clients that we have. And so it's providing these strategies and making them available on multiple platforms. So from our perspective, that hasn't changed. We're actually increasing the amount of strategies that we're offering in Ryan's area within the advisor-led segment, and we're continuing to offer those well within the trust segment. So why are we doing this? As Stacy maybe alluded to, the trust platform pretty antiquated. It's built on trust. The reality is our business over the last 10 plus years have evolved from kind of a trust focused area to much more investment management, IRA. It's the financial planning that we do for clients, and it's less based on that legacy trust business. And so we want to provide our customers as well as our employees with a better technology, better online experience, and just an overall better customer experience. So from our perspective, we're not decreasing the amount of our strategies. We're actually offering them on more platforms, and we think it'll provide clients, with a superior experience.
Well, that takes care of the questions that have come in for me. I don't know, Chriselle, if there was any kind of pre-call questions that came in that we want to ask?
We've got one that came in with regards to inflation. And I know you touched on it a little bit earlier, but what will happen to the US dollar as a result?
Yeah, two ways to answer that. First of all, higher inflation is negative for the US dollar. And so that is part of the thesis that economists have for a weakening dollar, which once again would benefit international returns. The one thing to always evaluate, though, is what's occurring with inflation in other parts of the world, or there's other factors. And so this is not just a U.S. phenomenon. We've seen, obviously, if you go to the gas station, higher oil prices, that's being, people are paying higher at gas stations in Europe, in Asia, and South America. So to a certain extent, currencies is always a relative game. What's the level of your interest rates versus the other country's counterpart? What's the level of inflation versus what's going on in other areas? So at the margin, I would say that would be part of the weakening the thesis, but you're also seeing that elsewhere, so that may not come to fruition.
And that's part of, back to Ryan's question earlier about the 10-year outlook for international stocks is very similar to the past 10 years. And really, we've seen a, flat to strengthening US dollar. So if that trend reverses and we do see some weakening of the dollar, that's probably one of the things that goes in that expectation is that the strong dollar has been a headwind for international stocks and international investing. If that changes at all, that will have more of a detriment to companies in the U.S. that sell internationally and will benefit that. So, probably one of the factors that goes into the international stock outlook being less dramatic in the change from the last 10 to the next 10.
Any last questions?
Those are the questions that I had. I think Ryan had one that came through as well, or that we already asked.
Yeah.
So, yeah.
Well, thank you again for your time. We appreciate your participation and your interest. I would say that the one call of action is that we're likely to be entering a different investment environment. So we think it's a great time to meet with your advisor team, meet with your trust officers, your portfolio managers, your individual advisors. The return environment may be changing from that perspective, but it's always good to do that annual review, refresh your outlook, update your financial plan if you have one. So once again, thank you for your time and interest.
Thank you.